So, Gene, this is your call on Apple. Obviously, it's been a bruising period for the stock. It is a beaten down valuation. Is this just a painful transition to the next phase of the Apple story? I mean, before you tell me why you're bullish on it, how did we get down to this level?
We got there because people are still focused on these iPhone units, and eliminating some of those disclosures spooked investors. And right after that, we had a chorus of negative data points coming out of Asia on the production of iPhones. So those two really pushed us to where we're at.
And so why is that, I guess, the storyline and the market's perspective going to change next year?
So every 10 years or so, there's a new paradigm, investing paradigm around Apple. The last one was around the iPhone. This next one is going to be Apple as a service. Now, we're not talking about the small 15% of their revenue that's a services segment. We're talking about the hardware performing like a subscription services type of a business. Now, unfortunately, there's probably risk to the March numbers. But despite that, we still think that this is going to be the best performer of the FAANG stocks in 2019 because over the next 4 quarters, we think this new reporting methodology will advance this idea that Apple is performing with some higher visibility, and investors will look at what is most important, which is revenue, earnings growth, and cash return to investors. And so it's going to take a few quarters for this shift, but ultimately it should be a meaningful positive to Apple's multiple. So that's why we are so upbeat on the story in 2019.
Now, Joel, I think you also feel like Apple is a buy at these levels. I mean, what are clients telling you for why maybe they're not being aggressive and staying away at this level?
Yeah, I think kind of, Gene touched on it a little bit. And I think last quarter, I think Cook and Company, they pulled, the iPhone metrics that have absolutely the worst time of the story at the peak of the, near the peak of the market as well. And, that clearly rattled a lot of people. Everyone knows the smartphone cycle is well past its peak. But, I know Gene's talked about it in the past, and it's pretty well clear. Their ASPs of the portfolio continue to rise. I think the average selling price is up about 26% this year over year. So they can survive with declining volumes. It's where the supply chain suffers the most. So I still would avoid the supply chain. I wouldn't buy it with your money. I think they're in for another round of pain in the coming quarters as well. But what I'd like to see from Apple is, clearly they want to become a services company. Start giving more metrics and as far as services go, breaking it down. And then also on the M&A front, they're sitting on a ton of cash. They want to be a leader in healthcare. They could make a big play there, or even within the content and kind of kick off their streaming initiatives, whether they buy a major content player or movie studio.
Yeah.
They need to make some more sexy headlines.
Gene, it seems like
Mike,
every day
can I
there's been
jump in on that? Just can I just make one clarifying point here? This live TV is probably not the right venue to do this, but I urge investors that Apple needs to give more kind of updates in terms of how their business is trending. What really would be ideal is for Apple to give an analyst day once every 2 years, just so that we can at least frame in some of these things like improving revenue per user. And I think there's a huge opportunity that the company has to advance investors' interest by giving a little bit more disclosure, if at all, once every 2 years.
Yeah, this has been a rallying cry from some analysts that the investor base, Gene, doesn't really understand the new model, that you can have Citi cut their Q1 10S forecast in half today, but how much does that matter if, in fact, as others argue, most of the profit growth over the next 5 years is going to come from services and wearables?
Right, and we need a little bit more guidance, given they've taken some of that visibility away with those reporting metrics. And so one of the largest companies in the world, I think it only makes sense that they would do an analyst day once every 2 years.
Joel, moving past Apple for a moment here, you cover quite a wide swath of tech and media names. What do you like here? What don't you like?
I'll start with what I don't like. I'm still very negative on Facebook. I still think, even yesterday, for instance, Team Zuckerberg, they kind of, in error, rolled out some new initiatives and platform changes to Instagram. The backlash was immediate, and they rolled it back almost kind of, relatively quickly. But I think they're doing a lot of tinkering with Instagram at the wrong time, and they're clearly trying to offset decline in their core newsfeed platform. And I think they're really running the risk of saturating Instagram stories with a ton of advertisements, which will, turn off the user base. So that's kind of my core thoughts on Facebook. And then in the semiconductor space, I still think rallies are to be sold. Even if a trade war eases with China, you still have a massive inventory pileup. Cloud digestion's going on in North America, in China, and Europe. And there's just a lot of red flags, whether it's cracks in the automotive, industrial end markets. So still wary of those names. And on the upside, really not. It's a consensus call, but cloud computing. I still think we're in the early innings of this digital transformation, to the cloud. It's real, and kind of names that we like, especially at Wedbush, or whether it's names like Workday, but mostly in the security space, names like Qualys, Zscaler, pure play cloud offerings that are continuing to, differentiate themselves with the product offerings.